Let me start with something nobody really tells you when you're buying your first investment property through a limited company. Year one is going to look pretty shocking on paper, and that's completely fine. It's by design. I'm in the middle of buying my first limited company purchase right now in 2026 in South Wales. And in this video, I'm going to walk you through exactly how I'm thinking about it, the tactics I'm using, and some of the things I wish someone had told me before I started. This isn't a textbook. This is what I'm actually doing right now in a market where interest rates are sitting around 5 to 6% for a buy-to-let limited company mortgage, which is genuinely tough, right? And it's scaring off a lot of landlords at the moment. So the first decision I made was to go in at 50% loan to value, which means a bigger deposit than most people would put down. And I want to explain why, because I think people misunderstand this. So yes, it gives you a better mortgage rate the more you can put down. That matters when rates are as they are right now. But there's a second reason that's just as important. I'm not trying to squeeze every bit of leverage out of this purchase because I want to protect my liquidity for the next one. And one of the biggest advantages of property is leverage. So using the bank's money to control an asset. If you tie up too much of your own cash in one deal, you usually lose the ability to move on quickly to the next one. So 50% is partly about this property and partly about keeping myself in the game. On the interest rates themselves, I'm not being put off by them at the moment. I'm going on a 2-year fixed and I'm betting that rates are going to come down. And when they do, I'm going to remortgage. That's the plan. So you're not married at the rate that you start with. Now the survey, I went for the best one, level 3 plus pro, whatever, full structural survey. And I want to tell you exactly why, because this is one of the most underused tools in property buying, I would say, that no one's talking about. So it's an older house, and older houses have more potential issues, right? A level 3 survey doesn't just flag those problems, it quantifies them. So any major repair above about £2,000 will get an actual number attached to it. And that number becomes a renegotiation weapon. Right? So based on what comes back, and I'll go through that maybe on another video, but I'm planning to go back to the seller and negotiate a fair amount for those repairs. So that might be, £5,000 to £7,000 off the agreed price, when the cost of a full survey is, £700. So the ROI is pretty ridiculous. So it's not emotional, it's not too cheeky, it's just the numbers, the facts around what things are going to cost to make it habitable. And there's something really important to remember. The initial agreed price is always subject to survey. That's not aggressive, that's just how it works, and you're entitled to go back. I also agreed at below market value anyway by about £5,000 because the garden needed work. So even before the survey and the renegotiation, I'm already, £5,000 below market value. So these things start to stack up, and it's important in these tough times in property. The property manager decision is something I spent proper time on. I compared about 5 agents in the area, looked at their rates, their terms and conditions, their presence locally, their reviews. I built a little spreadsheet in Notion, and I used AI to help me pull apart the detail as well in the contracts and compare them side by side. I'll do a separate video on how I'm using AI in the buying process because there's a lot to cover there. What I'll say here is that fully managed at 10% is pretty standard. However, in South Wales, I've noticed a lot of the bigger agents are charging up to 16%. You can negotiate with these if you mention, you're a portfolio landlord or you're building a portfolio. So they know there's future potential there to work with you, obviously in the area. So you're not just one property to them then, you're a potential 5 or 10 properties down the line sort of opportunity. On the financials, after mortgage, fees, property manager, landlord tax, all of that, I'm probably going to cash flow about £200 to £300 a month. So that's a nice steady cash flow. The gross yield's probably about 7%, which is good for property. And I would put appreciation conservatively about 2% per year. So that's about £3,000 a year just from the asset sitting there and you owning it. It's going to look bad if you look at stamp duty in the first year, definitely, which I do. It's probably going to be about £7,000. So I like to factor in the break even of that, which might take 2 to 3 years, which is why I said the first year in property, so the numbers are always going to look bad. The break even on the tax is part of the cost of entry though. So it's not a sign that the deal is wrong. It's just part of buying property in the UK. I'm using an app called Hammock to track everything. Landlord insurance, bookkeeping, tax records, how each property is performing, all in one place, and it links directly to where my accountant can get it. So if you're serious about doing this at scale, you need a system like this from day one, not a folder full of receipts 18 months in. The property I'm buying is what I'd call a turnkey rental. It's modernised inside, damp treated, new carpet, freshly painted. Everything cosmetic is done. The survey's flagged some work that needs to be done. But the bit that takes the most time, arguably, is painting skirting boards, the small stuff. I would have been doing that myself. So when I factor in the time needed to do that, it's good that it's already done and all the cosmetic work is there. Now, the limited company structure, because I think this is one of those things where people either do it or they don't do it and they don't understand why. If you're planning to build a portfolio of multiple properties, a limited company makes a lot of sense. If you just want 1 or 2 properties, it doesn't. And the reason nobody tells you this directly is because the answer depends on whether the extra costs justify themselves. You've got accountancy fees, you've got more admin, you've got a layer of complexity that you don't have as a private landlord. For one property, that overhead might not make sense. For 5 properties, it absolutely does make sense. Here's what makes it work for a growing portfolio. The deposit I've put in is as a director's loan. And what that means is that in practice, the profits the company makes each year, the corporation tax that would normally be due, is marked against the director loan that you're repaying. So for years, for absolute years, you're effectively paying no corporation tax. And that's a significant advantage. And it's because you've already paid tax on that. It's your personal money. You've paid income tax and all that. On top of that, interest on the mortgage is fully deductible, maintenance and repair costs are fully deductible, accountancy fees are deductible, bookkeeping software is deductible, the list goes on. The limited company structure turns a lot of the costs into legitimate business expenses in a way that personal ownership doesn't quite. So to pull everything together and to summarise, 50% loan to value to protect liquidity and get a better rate, 2-year fixed with the intention to remortgage when rates drop, Level 3 survey specifically to renegotiate with real numbers, below market value on entry because of the unfinished garden, property manager negotiated down and chosen carefully, director's loan structure to wipe corporate tax for years, Hammock to keep everything organised from day one. This is how I'm buying in 2026, in a tough market with high rates with intention. I'm going to do a follow-up video specifically on how I'm using AI throughout the process because there's a whole other conversation there.